Do. Okay, everybody. I am doing another quick real estate podcast, and I have some really good information for today that I'm super excited to share, and I think it'll be really beneficial to everybody. Before I do that, I'm going to release a more sales-based podcast, hopefully tomorrow, but for sure this week, kind of updating everyone on the state of how we're doing and giving some advice on that stuff, and really just, I guess, focused on our sales force. But in this podcast, because I'm releasing it first, I want to make sure to tell you guys how proud I am of you and how grateful I am that we all continue to work hard. August is a special time of the year. I hold it close to my heart because it's when the rubber meets the road and all of us really prove our character and our determination. For door-to-door sales reps, August is notorious for being a difficult month. Now, I'll tell you guys this. August has been a really killer month for our sales force. By far, we have blown out the rest of the partnerships and the grit on a ratio of our production in July and June to our ratio now. Like, we're blowing everyone out of the water. So I'm incredibly proud of each of you guys. I'm incredibly grateful for your efforts, and I'm inspired by what we're doing. I'm in here with you. I've been at the office earlier every day in August than the entire rest of the summer. Stayed here later. I obviously went out and knocked with San Diego, and I have a few more tricks up my sleeve. So I'm really proud of everybody. I'm still hungry. I want us to continue pushing. I want us to continue chasing down benchmarks and elevating our vision to do more and more and more. Another exciting thing about August is it's the time when we get to re-sign for the coming year. We currently have 95 sales reps already committed to 2024. And so I'm super excited to work with all 95 of you. And I know there's going to be dozens of others that are currently out selling that will make that decision. Your second year selling is always, well, it should always be an improvement from your first year. On average, sales reps will sell 40% more without putting in a ton of extra effort from their first year to their second year, because you beat the learning curve, you know what to expect, you start out hotter, and all those other things. Now, if you're like a lot of our sales reps, you will double, triple, quadruple your production from your first year to your second year. And we have dozens of examples of sales reps who are doing and did that. And even on a high level, we have guys like Will Fulton going from 160K to 260 plus K. We have guys like John Martin going from 200K to, well, he's at like 320 right now, and he's going to hopefully end at 400K. We have guys like Chase Flynn who are going from 160K to approaching 200K, going to hit 250K before postseason's over, and recruiting $1 million in his downline. We have guys like Aiden Parent, Andrew Miller. We have people doing really, really awesome things in their second year and their third year and their fourth year and their fifth year. And even guys like Colby Markowski, who have never done more than 200, 225K in a summer, going out and chasing down 350, 400K in revenue. So improvements are huge. Improvements are awesome. And we are the improvement partnership, and we are going to continue dominating and continue making those improvements. I'll talk more about that in the next podcast, but I want to get it out there and I want to get everybody excited about it. Also, if you didn't hear, I want to remind you guys, once you've re-signed starting this last Monday, you will get $200 in upfront pay commissions. This is a way to get more money to our reps faster and reward them for our hard work. It obviously doesn't change your overall earnings on the account. We want to make sure you guys are hitting benchmarks, but it does change when you get the money. And money now is always a good decision. So re-sign, hit those benchmarks, get the 200 up front, do postseason if you can, and let's keep pushing. Really proud of all you guys. Really grateful for all of you. I freaking love this group. Like, I love this group, and I pour my heart and soul into it, and I'm going to keep doing that. And I'm excited to work with all you guys. So the future is bright. On that note, I'm going to share my screen and go over the real estate training that I have. This has been something that I've been thinking a lot about the last few weeks and months, and it's a little bit hodgepodge, so bear with me if it's not perfect, but I think this is some really great information, and I'm super excited to share it with you guys. And this is buying real estate this year in the next 12 months. Is it possible, and what you should be doing and what it could look like? Now, for a lot of you, it is possible this year. If you've sold 2 years with us, it should for sure be possible. And we might have to get creative, and we might have to move markets, and we might have to, do some different things, but it should be possible for sure. If you haven't sold with us for 2 years yet, and I'll talk more about why that timeline's important, but if you haven't sold with us yet, it's not the end of the world. It might still be possible. And we'll talk about the capacities and the ways to make it happen and things like that. So last time I did a training on loans and financing options and the different down payment options and the different loan programs and things like that. Go back and watch that training if you didn't, or if you did, you can watch it again. I'm going to do a brief recap on that. So the first way to buy real estate is just through traditional financing. Now, all of us at Aptive, we are paid through a 1099, which when you go to get a loan, it looks like you're your own little business or you're self-employed. Now, banks and, the financial institution, unfortunately, they do not reward us for being hustlers. They do not reward us for, going out on a limb and being risky and trying something new. In fact, they penalize us, which is a huge pain in the butt. You have to have 2 years of work history, 2 years of filed taxes before a traditional bank will really give you a loan. And so you go out, you sell this summer, you file your taxes in January. You go out and you sell a second summer, you file your taxes in January. At that point, you're a really good candidate for traditional financing. Okay. It takes most people in our situation 3, 4, 5 years before they can really make real estate happen on a high level. And myself, guys, I didn't know about real estate when I got into this job. Unfortunately, I didn't buy my first property until after my 3rd summer. I wish I would have bought it sooner, but it takes time. Okay. Now, if you went and you worked at Jiffy Lube and they pay you on a W-2, they only want like 2 pay stubs, like 30 days work history, because they see that as a secure job and they see that your income is like repeatable. With us, the income's not repeatable. So they want more history showing that we're going to be able to continue to earn the money and do it again and again and again. So that's why they make it that way, which is frustrating and hard. But there's some ways around it, and there's some things you can do to maximize the opportunity when the time comes and other things like that. The first thing that I'll talk about is a good debt to income ratio. So all traditional financing, they will base your approval off of your debt to income ratio. Now, what does that mean? Okay, debt is how much you have in outgoing payments every month. Income is how much money you report on your taxes. So let me explain that a little bit deeper. If you have a car payment for $1,000 a month and you have a student loan for $400 a month and you have a credit card for $200 a month, that is $1,600 a month in debt payments. Now that debt is going to affect this golden ratio, how you get approved. The income part is where this gets really fun. If you make $1 million in a year, but you're an expert at writing stuff off your taxes, and you only report that you made $60,000, okay, that's only $5,000 a month to the bank. So when they go to approve you, you've only got $5,000 a month in income. And this ratio, they want you to have enough income on top of the monthly payment that you can comfortably afford this house and a car and food and life expenses. So most banks want you to have like a 30 to 40% debt to income ratio, depending on the type of loan and the location and things like that. So if you want to buy a house that's $3,000 a month and you have $1,600 in debt and you only make $5,000 a month on paper, you're probably not going to get approved for that house, because they know that you need to eat, and they know that you have a cell phone bill, and they know that you have all these other things that are required to live. Your debt to income ratio is not good, even though you're making $1 million a year, because you wrote so much off your taxes. Now, the flip side of that, if you make $80,000 a year and you have zero debt and you report all $80,000 to the bank, they're going to look at that and they're going to say, okay, this kid makes $7,000 a month. That's pretty good. He can probably afford a house that's $2,000 a month because he has no other outgoing payments and he makes $7,000 a month. So in that situation, the guy making 80 grand would get approved for more than the guy making $1 million a year. So what is important to remember in this situation? Thing number one, buying cars, buying expensive toys, financing things like that is fun. It's awesome. Obviously, I'm guilty of it, but it will affect your ability to buy real estate. And you have to be really, really smart in how you do it. Am I saying don't do it? No, I'm saying be smart and understand what it affects. Understand the pros, understand the cons, and be aware of those things. If you want to buy a house and you go out and you buy a $200,000 car, it's going to be hard to buy a house for a while. You got to get your income up. The other thing I'm saying with this is be conscientious of what you're going to do in the year when you file your taxes. I always encourage meeting with a loan officer and discussing how much you should report. Because if you make $200,000 next summer, or if you make 80 grand this year, but you write all of that off to where you report zero income, it's going to be really, really hard to get approved for a loan. And so real estate is kind of a pay to play game. You have to pay some taxes in order to be able to invest in real estate. Okay, moving on, because I have a lot of stuff. You have to have a good credit score and a good credit history. Make your payments on time, get credit cards, use them, build up a credit score. If you've financed a car, make payments on that car for at least a year. If you've never financed anything in your life, get a car loan. The car loan is going to be a higher interest rate and it's going to suck, but pay it down and then make monthly payments for at least a year. That will help build your credit score and your credit history. And we'll talk more about that in future podcasts. Down payment options on traditional financing, they're typically going to want as low as 3.5% down if you move into the house and 20 to 25% down if you do not move into the property. So if it's just an investment fourplex, they're going to want like 25% down. Closing costs. When you go and you get a loan on a house, if it's a $200,000 loan, you're going to pay $4,000 to $6,000 in closing costs on that property. That pays the title company, that pays the loan officer. It's where all those guys get paid. So just be aware of that. And you can only have 10 personal loans max in your name. So like I'm maxed out. I can't go buy a cabin. I can't go buy a house with traditional financing because I'm maxed out. Now I was smart, and I'm going to tell all of you this now because people make this mistake. If you are married or if you plan to get married, do not put your significant other's names on the loans when you buy properties. Because what happens is once you get to 10, you can, and obviously consult an accountant and talk to a lawyer and all this stuff. But like what I did is I made Emma, my wife, a 30 to 40% owner of my LLC for Aptive. And now Emma can go and get 10 loans in her name. And I think Emma has like 4 or 5 loans in her name at this point. So we still have a few that we can use because she's a 30, 40% owner of Garrett Myers Enterprises. And now when I finance a Ferrari and I finance a boat and I finance all this crap, it doesn't affect Emma because those are in my name and she just has a piece of my business that produces income and has no debt to her name. So it's a great setup. Okay, moving on. DSCR loans. You guys are going to hear more and more about these as time goes on. They're relatively new to me, and I think they're relatively new to the marketplace, but they seem awesome. I'm actually looking at getting one right now down in Arizona. DSCR stands for Debt Service Coverage Loans. Okay, debt service coverage loans. Debt service coverage loans. They are concerned with the cash flow of the property, and they're not based on the borrower's credit score or credit history. So these are a loan, these are a loan for investors. It's not a loan that you would use to like go buy a house to live in. It's a loan that you would use to buy a fourplex or a duplex or a triplex or something like that. And it's awesome. Okay. They typically have a higher down payment requirement. You're usually going to have to put at least 20, 25% down, and they may have a slightly higher interest rate. So this is a loan that banks can give based on a property being an income producing asset. A bank is going to look at this fourplex and say, okay, the monthly payment on this fourplex is going to be $2,000 and this fourplex is rented out at $3,000. Garrett may or may not be an idiot, but if we get him to give us $20,000 or $80,000 as the down payment, and we know that this property is incoming $1,000 a month, we're probably pretty protected in that situation. Okay, that's what this loan is. So it's a debt service coverage loan where the bank is insulated because you've put enough money down, and they're also insulated because they are collecting income from that property every month if you default. So guys, as you learn about traditional financing, as you learn about banks, they are very, very good at sheltering themselves from risk. And traditional financing can be a little bit risky if you only put 3.5% down. And you'll remember that's why you have mortgage insurance. Debt service coverage loans are less risky to the bank because they're giving them on income producing assets with a large down payment. So that's why the borrower's credit score and credit history don't matter quite as much. Okay, seller finance. Now, this is something that we will do future podcasts on as well. We're going to do tons of material on this subject, and I'm still learning about it myself. There's so much to learn in the world of real estate, and especially when you get into creative financing. So I'm going to spend 5 to 10 minutes telling a couple stories about seller finance, giving some basics, kind of the ins and outs, but just know that this is a topic that we're going to discuss for forever. So seller finance, everything is open to negotiation. The down payment is flexible. The interest rate is flexible. The length of this seller finance deal is flexible. The terms are all up in the air. Okay, everything is open to negotiation. A typical seller finance deal, and we'll talk about a few options here, is someone who owns the property outright. Okay, they own a fourplex and they owe zero money to a bank on it. So it's theirs, free and clear. They own the asset. You go to them as the investor and you say, hey, I will give you $100,000 now, and then I'll still owe, maybe you set the purchase price at $350,000. I'll still owe you $250,000. I will pay you $3 a month for the next 2 years. And then in 2 years, I'm going to pay you the full $250,000. You could do that in a seller finance deal. You could say, hey, I'm going to put zero down, no money out of my pocket. In fact, you're going to give me $10,000. I get $10,000 from you, and I'm going to take ownership of this property, but I'm going to pay you $15,000 a month for the next 2 years. You could do that in a seller finance deal. Everything is open to negotiation. So whatever the sellers agree to and whatever you as the buyer agrees to, you can do it in a seller finance deal. And you want to have airtight contracts, and you want to make sure it's all written perfectly, and you want to make sure it's all understood, but everything is possible. Now, typically with a seller finance deal, you're going to want to find the hot button of the seller. Some sellers will care a ton about the down payment, but they're willing to give you a killer interest rate. Some sellers don't care about the down payment, but they want to feel like they're making money on the interest rate. Some sellers just want to get out of the property, and they'll finance it to you on a low down payment and a low interest rate, but they're only going to want to finance it for a year or two. So you have to refinance after that time period. Everything is open to negotiation. One example of a seller finance, I'll share a couple really quick. The storage units that Chandler and I bought, we bought for $1.2 million. Now, if I were to go get a loan from a bank, we would have had to have put $350,000 down. Because we got them on a seller finance, we put $250,000 down. So we saved money on the down payment. If we would have gotten a loan from a bank at that point, we probably would have gotten a 3.5% interest rate. Because we financed with the seller, we had a 4% interest rate. So the seller felt like he was making some money on that interest. The seller did not want to finance the property forever for us, so we had to refinance, pay the property off, or essentially get the seller all of his money within 5 years. Okay. Another example of a seller finance property, I have a triplex. It's over on Boulevard Street. The seller cared some about the down payment, but they cared quite a bit about the interest rate. I put 15% down. Had I financed it with a bank, I probably would have had to put 25% down. So I saved myself money on the down payment, but the seller wanted a 5% interest rate. If I would have financed with a bank, I probably would have had a 3% interest rate. So I lost money on interest every month because of this deal, but I saved myself money on the down payment, and the seller was open to doing it for a full 30 years. So I'm locked in on that baby. It's a great deal for me because I still cash flow on the 5%, and I saved myself more money out of pocket. Will Fulton just went under contract on a seller finance deal yesterday. And this one's a little bit different, and I'll talk about it here in just a second. It's more of a subject to seller finance. This lady bought the house less than a year ago for like $320,000. She borrowed the down payment assistance is what that's called, and financed the property. So she had a pretty high monthly payment and unfortunately didn't have any equity and came into some hardships. So she has missed her monthly payments since like February. So she owes $15,000 in back owed payments and is in hot water. Now, this poor lady is going to be foreclosed on if someone doesn't take over the payments and buy out her bad debt. And so Will goes in and buys out her bad debt. It's going to be like 20 grand all said and done, and then takes over her exact monthly payment. Okay. So she doesn't really care about interest rate. She doesn't really care about down payment. She doesn't really care about term. She just doesn't want to ruin her credit and get foreclosed on. So Will is solving all of those problems for her. This is another example of seller finance. I'm sure there will be questions on this. I'm sure there will be things that I probably didn't explain perfectly. Comment down below. I'm happy to answer the comments, or text me or Instagram me, and I'll help there as well. How do you find a seller finance? This is the golden question. If we could find unlimited seller finance deals, none of us would need to knock doors and we'd all be filthy rich, because they are very, very valuable, or they can be at least. Some sellers have their heads up in the clouds. Like I was looking at a place down in Arizona the other day where the sellers wanted me to put 25% down and pay 10% interest. And I'm like, well, I can just go to a bank and get better terms than that. Some sellers will give unfavorable terms to people who can't get loans. It's kind of like a hard money loan at that point, and that's something that we'll talk about another day as well. Subject to has been around for a long time, but is really, really trendy right now with interest rates high. So what a subject to is it's subject to the existing loan. So like this lady that Will's buying the house from, she has a 3.875 interest rate, and she has that on a fixed rate mortgage for the next 30 years. So Will is buying the house, he's paying off her bad debt, subject to her existing loan. So he is going to continue making payments on her existing loan. This lady's name is still on that loan. Will is going to make payments to the title company. The title company will make payments to her loan department. So we are buying it subject to her existing mortgage. If you guys look up someone, Pace Morby on Instagram, he's kind of like the king of subject to loans right now. They're a really, really awesome option, and I think they're going to become even more popular as time goes on, because interest rates were so low for 2 or 3 years, and now they're so high. And not only that, but especially people that bought the house like 12 to 18 months ago, the market's actually dipped a little bit. So if those guys want to sell, they can't sell. They're losing money on the house, but their monthly payment is, you know, $1,000, $1,200, $1,500, $2,000 cheaper than if you were to go get a new mortgage right now, even with a lower purchase price, because their interest rate is so good compared to what interest rates are right now. Now, subject to, you can have people who have tons of equity in the house. You can have people that have no equity in the house, like the situation with Will. Some of these sellers may want you to pay off all of their equity, so you'd have to put a huge down payment down. Some of them may want to finance that equity. So if they have $100,000 equity and you're only putting $20,000 down, they may want you to pay 5, 6, 7, 10% on this $80,000 until you pay that off, because that's their money. It's their equity. They might not have any equity, and you just take over their loan, like the situation with Will. Now, subject to is not just this perfect golden answer. There are risks involved, just like with every investment product. The bank, the seller's bank, could theoretically call the note due and say, hey, this loan was only for Sarah, it's not for Will. And at that situation, we would have to sell the property, we'd have to refinance or pay it off pretty quick because they called the note due. So there's some risks, and you want to be an expert at this. You want to be good at it. You want to make sure you've crossed your T's and dotted your I's before diving right in. And again, I will give more information on these in the future, but I am working aggressively and hard to find as many seller finance and subject to deals as I possibly can this year to help a bunch of you guys get into first houses, okay, and investment properties. And I think we're going to have really, really good luck with it. So if you do not have 2 years work history yet, do not despair. There's a good chance that we're going to be able to find you something beautiful and sexy and awesome in the seller finance and subject to department. And maybe if you've got a good down payment, we can find you a DSCR loan. So still be excited, still be pumped, still continue to work with us. Now, there are a couple other options. You can pay cash. Chandler's first property that he ever bought, he made like 100 grand his first summer. He went and paid $75,000 cash for a condo in Rexburg, Idaho. Bought it cash. Okay, back then purchase prices were a little bit lower. Now you're going to say, Garrett, there's no properties anywhere in the world that I could pay cash for. That's not true. If you look in Missouri, if you look in Alabama, if you look in a lot of these kind of Midwest, maybe southern markets, there are houses for sale for 30, 40, 50, 70, $20,000. There are houses for sale for $12,000. You won't believe me? It's true. Hit me up and I can show you a few of the markets. Now you're going to say, what's wrong with that market? Great question. That's why it's so cheap. Obviously, there's something that's making the market not appreciate. Maybe it's really low income. Maybe it's really beat up. Maybe it's really sketchy. Maybe it's just on the fringe of starting to appreciate, but no one's wanted to live there previously. When people looked at Idaho Falls 10 years ago, they said this market has no appreciation. You could buy a little house for $70,000. Now in Idaho Falls, you can't find anything for less than $200,000. So just because it's cheap doesn't mean it's good, doesn't mean it's bad. It means you should look into it more. But paying cash is an option. Mitch Fry, Damon Lilly, and myself, we are paying cash for a fourplex in Ohio, and we're supposed to close in like 2 weeks. It's a $200,000 fourplex, and it rents at $3,500 a month. We're each putting 70 grand down. It's going to be awesome. After we take ownership of the property, we're going to refinance into something like a debt service coverage loan and get most of our money back. So this is an option, and it is a great option. And for a lot of you guys that don't have any work history, but you're making great money this year, it's an interesting option that could help you get into some properties this year. One thing I failed to mention with this one, you can get a cosigner. So a good example of this would be, I'm really close to Will's situation because I've helped him a couple times this year, so I'll use him again as an example. Will bought that house in Idaho after his first year working with us. He filed 1 year's tax history and he bought the house. How did he do it? He had his parents co-sign with him. They didn't put forth any of the money. They haven't made any of the monthly payments. It is 100% Will's house, but the bank was able to look at his parents' history and say, hey, if he doesn't make the payments, will you make it? And they said yes. And so they loaned the money to him. Oh, you're good. Hey, Chance, got the sneaker store running. We're making sales, beating you guys on the incentive. So a cosigner. And then the last thing that I will say, and this could be a cool option for a lot of you guys, invest in a fund, okay? You can invest in a real estate fund. There's millions of them where you don't directly own the asset, but you're an investor in it. And the fund owns the asset. So if you follow Brandon Turner on Instagram, he used to be the host of Bigger Pockets. Brandon Turner is a fund machine. He is buying thousands of units a year, all with other people's money in this fund model. The fund model is a great model because you have a really professional real estate investor who is finding killer deals and then skimming some of the profit off the top. But the profit is still really good for the people who invest in the funds, and perhaps even better than you could find on your own. Like a lot of these funds, the investors are making 10 to 20% without doing any work. And the real estate investor who owns the fund, who runs the fund, is making 5 to 10% on top of that. Mitch, David, and I are actually trying to start a little fund in Ohio. So that's kind of in the cards for us. And you could theoretically invest in a fund without being able to buy a property on your own and still invest and own real estate. So that's another really awesome option. I am going to wrap up the call here. I hope this is good information. This will definitely spur some questions in your mind. I would love to see a bunch of us get into real estate this year, and I think we're going to make it happen. I know Tyler Brown's going to get into real estate this year. I know Greg Lowe's going to get into real estate this year. I know all of our team leaders that already own real estate are going to buy properties this year. I talked to Colby today. He's looking at a sixplex. I know my brother Andrew has been looking at a couple duplexes. I know Chase Flynn has been looking at a bunch of properties. I'm supposed to call our rookie rep Titus, who did 100K in 2 months right after this call. He's looking at a house. So good things are happening. Gideon's going to buy property this year. Let me call some more people out. Mitch and McKenna are going to buy a bunch of properties this year. Derek Beardsley's been popping off. Aiden and Andrew are going to buy a bunch of properties this year. Andrew Jones already owns a house. We're going to get him into more. We need to get John Martin into property this year. We have a bunch of us that are going to be buying real estate this year. It's going to be awesome. So get excited, get hungry, get motivated. Real estate is the future. Aptive will help make us all rich. Real estate will make us all wealthy. Wealth lasts longer. Let's all get wealthy. So I love you guys. I believe in you guys. Please work hard. Okay. Look forward to that podcast and let me know what questions you have and if you need anything else. Thanks.